Imagine waking up every day, going to work, earning a paycheck. But before the month even ends, your money is gone. Rent, groceries, gas, insurance, car payments, and unexpected bills keep piling up. When people run out of cash, they reach for one thing: credit cards. Today, Americans owe more than $1.28 trillion in credit card debt. That's the highest level in history. The big question is, why are millions of Americans drowning in debt despite living in the world's largest economy? And could this be the warning sign of a future financial crisis? Stay until the end, because the numbers behind America's debt problem are shocking. Part 1. The real reason. Americans are borrowing more money. Many people believe Americans are spending too much on luxury items, but the reality is very different. The biggest reason behind rising debt is simple. The cost of living has exploded. Over the last few years, housing costs, groceries, healthcare, insurance, and everyday necessities have become significantly more expensive. While prices have increased rapidly, wages haven't always kept pace. As a result, many families are using credit cards not for vacations or expensive gadgets, but for basic survival. Think about it. If your monthly expenses are higher than your monthly income, eventually you'll have to borrow money. That's exactly what's happening across America. Millions of people are relying on credit cards to cover everyday expenses and unexpected emergencies. And that's where the debt cycle begins. Part 2, the credit card trap nobody talks about now. Let's understand why credit card debt becomes so dangerous. Imagine someone spends $5,000 using a credit card. If they don't pay the full balance on time, interest starts accumulating. Many American credit cards charge interest rates above 20%. At first, people make only the minimum payment required. It feels manageable. The debt doesn't seem too serious. But here's the problem. Most of the payment goes toward interest rather than reducing the original balance. Month after month, the debt keeps growing. A $5,000 balance can eventually become $7,000, $8,000, or even $10,000. This is why so many Americans struggle to escape debt. They're not just paying back what they borrowed. They're paying interest on top of interest. It's like trying to climb out of a hole while the hole keeps getting deeper. Part 3. America's massive debt problem. Credit card debt is only part of the story. When we look at total household debt in America, the numbers become even more unbelievable. American households owe nearly $19 trillion in combined debt. This includes mortgages, student loans, auto loans, personal loans, credit card debt. Think about that for a moment. Trillions of dollars of borrowed money. The modern economy is heavily dependent on debt. Many families are financing homes, cars, education, and even daily expenses through borrowing. While debt can help people build wealth when used wisely, excessive debt creates financial pressure and increases economic risks. Part 4. How AI is changing America's economy. At the same time, another major trend is transforming America: artificial intelligence. Companies are investing hundreds of billions of dollars into AI technology, data centers, and advanced computing infrastructure. Tech giants are racing to dominate the AI revolution. This investment is creating jobs and fueling economic growth. But there's another side to the story. Massive spending can also contribute to economic pressure, affect interest rates, and reshape financial markets. In other words, AI could become one of the biggest wealth creators in history, or it could create new economic challenges that nobody fully understands yet. That's why investors around the world are watching the AI boom very closely. Part 5. The housing crisis continues. Another major issue facing Americans is housing affordability. Mortgage rates remain much higher than they were just a few years ago. As borrowing costs increase, buying a home becomes more expensive. Monthly mortgage payments rise. Families have less money available for savings and daily expenses. Many people who once dreamed of buying a home are now delaying that goal. Others are turning to credit cards and personal loans to manage financial pressure. This creates yet another layer of debt in the economy. Conclusion. So what does all of this mean? America remains the world's largest economy. Its companies continue to lead in technology, innovation, and global business. But beneath the surface, millions of households are facing growing financial pressure. Credit card debt is at record levels. Household debt is approaching $19 trillion. High living costs and expensive borrowing continue to challenge ordinary families. The biggest lesson is simple. No matter where you live, America, India, or anywhere else, living beyond your means can eventually lead disappearing. Rather, it means countries are exploring additional options. The dollar remains dominant, but the financial world is becoming more diversified. Chapter 5. Could another currency replace the dollar? Whenever people discuss the future of the dollar, one question always appears. What could replace it? Several possibilities are often mentioned. The euro is one candidate, because it represents a large economic region. China's currency is another, because China plays a major role in global trade. Some people believe gold could regain importance. Others argue that cryptocurrencies may become part of future financial systems. However, replacing the dollar is much more difficult than many people realize. A global reserve currency requires more than economic strength. It needs deep financial markets, strong institutions, political stability, legal protections, and most importantly, global trust. Building that level of trust takes decades. For now, no single alternative appears capable of completely replacing the dollar. Instead, the future may involve a more balanced system where multiple currencies play larger roles. Chapter 6. What happens if the dollar weakens? Let's imagine a scenario where the dollar loses some of its global influence. What could happen? First, imported goods could become more expensive. Since America buys products from around the world, a weaker dollar could increase costs for consumers. Second, inflation might rise. Higher import prices often lead to higher consumer prices. Third, borrowing costs could increase. If investors demand higher returns to hold government debt, interest rates may rise. This could affect mortgages, car loan, and business investments. Financial markets could also become more volatile. Investors dislike uncertainty, and when uncertainty increases, market fluctuations often follow. However, it's important to remember that a weaker dollar does not automatically mean economic collapse. Currencies rise and fall over time. The impact would depend on how quickly changes occur, and how governments, businesses, and investors respond. Conclusion. The US dollar has been the foundation of the global financial system for generations. Its strength comes from trust, stability, and widespread use. Today, that position remains incredibly powerful. However, the world is changing. New technologies are emerging. Global economic power is becoming more distributed, and countries are exploring alternatives. Does this mean the dollar is about to collapse? Not necessarily, but it does mean that the future of global finance may look very different from the past, whether the dollar remains dominant or shares power with other currencies. One thing is certain, the decisions being made today will shape the global economy for decades to come, and because the dollar touches nearly every aspect of international finance, its future matters to everyone. If you enjoyed this video, don't forget to like, subscribe, and share. And now we'd love to hear from you. Do you think the US dollar will remain the world's most powerful currency? Or will a new challenger emerge? Let us know in the comments below. Thanks for watching, and we'll see you in the next video.